James, thank you for joining us. How did the Factor series fare in December?
December was a mixed month for the Factor series. We had Factor 3, which is the lowest risk of the three funds, providing a small positive return. Factors 4 and 5 down between 0.6 and 0.8% over the month, which is within reasonable expectations, particularly in a month where the UK market was down 2.3%. Over longer time periods, now's a good time to reflect on the year perhaps. 2014, the funds returned, all of them around about 5%. And to give us some context, the UK market was up about 0.5%, so a handsome outperformance of the UK market over that period.
James, what then were the main themes for the month?
Well, I suppose it was a continuation of what really defined November, the fall in the oil price, weighing on the energy sector particularly. Global equities were down over the period, about 1.6%, as the US, UK, Europe and Japan all posted negative returns in their respective local currencies. Emerging markets underperformed, down about 5% over the month, to cap what was a pretty average year for emerging markets in fact. Turning to the year, global equity up about 5%, driven strongly by the US and other reasonable returns from regional equity markets, but translating into US dollars, they were hampered a little bit by the strength of the US dollar. Emerging markets down around about 2%, and that's the second year in the row, in fact, that we've had emerging markets produce a negative return. And it's the first time in 12 years we've seen that, so not a good little period here for emerging market equity. Turning to the debt markets, emerging market debt, while we're on the subject, did pretty well, up 6%, which is in line with the US Treasury market on the hard currency side of the emerging market debt market, which is not bad given the negative sentiment to the region as we've seen in the emerging market equity market. Fixed income generally did well. Government bonds particularly doing pretty well over the year. The US 10-year started the year at 3%, moved down to 2% by the end of the year. Pretty much a linear move, not completely of course. The UK gilt doing roughly the same, so producing decent positive returns over that period. Credit markets didn't really do quite as well on the whole. We had a reasonable time for credit, helped by that move down in the reference rate, but generally spreads not doing enough to sort of add to that return, so we had sort of mixed fortunes in the credit market really over that period.
James, we're now in January, an appropriate time maybe to look back at the whole 12 months. Therefore, what were the main asset allocation drivers behind performance in 2014?
Okay, well, the Factor series really, I suppose, did well from having a reasonable amount in the equity market. Even the UK was sort of flat to slightly up. And global equity allocation did well for the portfolios. That market did well, particularly in sterling terms, of course, as sterling was somewhat weak, particularly against US dollar over the period. Our non-UK country-specific exposure, particularly Japan, did well. We hedged that back into sterling. So again, you've got all the local currency return of the Japanese market, which was a double-digit return. Infrastructure also did well for the portfolios over the year. Emerging market equity, however, detracted from performance, as that was a pretty weak section of the market over this period. We could have done with more government bonds. The gilt market was up in double digits over the year, which is a very good return. We had a decent allocation to various parts of the credit market, including investment grade credit, loans, EMD, high yield and convertible debt. And while they all produced, most of them produced positive returns over the year, not across the board, they failed to keep up with the government bond market, which had an incredible return over the year. So we could have done with more government bonds, but the credit market did reasonably well and provided a positive return overall to our portfolios.
If I may, James, I want just to draw you on the EM position and then maybe the government bond position. Now, as you said, they've not necessarily worked this year. Is it a case of you, as the portfolio manager, needing to kind of stick to your conviction on this one?
Well, on the emerging market equity side, we have to constantly question our positions. We'd be wrong to be naively sticking to our knitting, if you like. And clearly there are headwinds that emerging markets face today, but most of those are macroeconomic headwinds. I mean, the strong dollar, for example, is something that should be a cause for concern from a macroeconomic perspective and potentially for a debt holder perspective. It doesn't necessarily bode badly for the corporate sector. And the fall in oil, conversely, it's very good for consumer tend to have a large energy component in the consumption basket, so that gives them a lot of breathing space. It's effectively a tax cut. We should see more activity on the consumption side, should bode well for corporate profitability therefore. So that's a very short-term phenomenon. That's not why we're invested in emerging markets, but it's another example of why we might see a good outcome for emerging market equities. Moving on to the debt side, you mentioned high quality sovereign debt. We really, again, it's a valuation argument for being lowly allocated there. We're getting 2%, in fact sub 2% today from the likes of the UK 10-year, the US 10-year, and in fact the German 5-year Bund is in negative yield territory, so you're having to pay to lend to the German government for 5 years, which is a remarkable state of affairs. The markets are either telling us that the yields are being kept artificially low by extraordinary monetary policy, QE and the like, or they're expecting poor GDP growth and probably negative inflationary scenario, or some other risk aversion trade where bonds are the only place you want to be allocating today. Of those three scenarios, we still have extraordinary policy, monetary policy, so that's part of it. Do we see deflation? Only in Europe potentially there's a risk of deflation. I don't see risk in the US and UK, for example. So maybe it is just a case of people really don't see anywhere else that's a true safe haven today. Maybe that's a crowded trade. It does look expensive to us. The risks look asymmetric to us. You've only got a limited upside from here mathematically. You've got a reasonable downside from here actually. And so while we don't want to be completely without government bonds in our portfolios, they're a useful risk diversification tool, and they do provide a port in a storm. We don't want to have too much in the portfolios today because we do think it's expensive.
How are the factor portfolios positioned today?
Well, the funds have got a decent weight to the UK, as you'd expect, a sort of UK-focused portfolio, but we've got global exposure as well, and that certainly helped last year. Across the range, obviously less equity in factor 3, moderate amount and a higher amount in factor 5. With the UK bias, but we've also got the likes of global exposure through Morgan Stanley, we've got Copenhagen, we've got infrastructure securities, emerging markets, and Henderson as well as examples, giving us a broader global scope than we otherwise would if we just stuck with the UK. On the fixed income side, we are low on the government bond side, as we've already mentioned, with overweights across the credit spectrum. And we've got a decent chunk in cash as well to put into the markets as and when we see valuation opportunities present themselves, which we think they will as the year progresses.
And finally, looking forward to 2015, James, what can we expect?
Well, we recorded yesterday a 2014 review and outlook of 15, and I would encourage people, if they want real detail, to have a look at that video. But in summary, more of the same, really. Equity markets don't look too expensive. They don't look particularly cheap today. They're sort of a rich fair value, but they still look pretty good compared to the variety of other asset classes available to us, particularly government bonds, which look expensive. And even the credit market in places, you need to tread carefully today to make sure you're buying genuinely cheap assets. We think the volatility will continue to be elevated this year. We've seen the last couple of years volatility has been low, unusually low. We saw it spike up in sort of September to November last year, and those kind of conditions are much more the kind we expect to see this year. Much more regular returns of volatility, maybe even a sort of consistent elevation in volatility throughout the year. In that environment, risk controls are very important. It's key to build that into your portfolio construction process. Make sure you don't have too many eggs in any one basket. A diversified base of returns driver in the portfolios, but a portfolio that's still positioned for growth. Ultimately, we're not particularly negative on equities, on the global economic outlook. There's a lot of green shoots, a lot of reasons to be positive. Plus, even where it's looking a little bit bleak, we've got a lot of central bank activity to sort of provide the foundation for a reasonable year.
James, thank you very much.
Thanks, Richard.